What is up, everyone? Welcome to Investing Club. In this video, I'm going to show you 3 stocks that I think could be a good buy in the month of July 2020. Now I'm going to talk about some different stocks in this video. Most of my YouTube videos this far have been smaller companies that you probably haven't heard of. And the reason I talk about those a lot is because that's where I'm finding the most value in stocks. But the truth is, so in this video, I'm going to show you 3 stocks from the Dow Jones Index that I think are a buy. And even though my portfolio is all small cap stocks right now, I have nothing against companies in the Dow Jones or the S&P 500. These are all great companies. These are the best companies in the United States. That's why they're in the index. But the reason I haven't bought any is just because I think all the stocks in an index like the Dow Jones, the vast majority, if not, are overvalued or fairly valued, not extremely undervalued like the stocks I like to look for. So in this video, I'm going to show you 3 stocks from the Dow 30 that if I had to invest out of those 30 stocks, here are the 3 that I would choose, and I'm going to show you my thoughts on them and what kind of return you could expect over the next few years by buying these stocks now. And before we go over the stocks, I'm not a financial advisor, and you should not consider this financial advice. I'm just presenting these stocks to you as ideas, and you should always do your own research if you decide to invest in any of these. So let's get right into the video. The first stock from the Dow Jones is UNH, United Health Group, and United Health is one of the largest healthcare companies in the country. And there's a lot of things I like about this company. First is that their earnings have been consistently growing at a pretty fast rate. Over the last 5 years, they've grown at 20%. And over the next 5 years, it's going to slow down a little bit, but still their earnings are going to grow at 12% a year. And so that kind of growth is something that will definitely give you returns compared to other companies that are only growing at 2 or 3% a year. They're also not priced too expensively. Their forward PE is around 16, so I would say this company is fairly valued. Not super undervalued, but not overvalued either. In my opinion, this is a fair price for this stock. Another ratio I like to look at is price to free cash flow, which is a 24, which is not the best, but it shows that this company is generating a lot of free cash flow, which is something I definitely like to see. They're paying a 1.68% dividend currently, and their payout ratio is only around 30%. So this dividend is most likely going to be safe throughout this period where it's not clear what's going to happen to the economy. And 1.68% is not the best. There's definitely higher yields out there, but for a company like this where it's probably safe, and in an environment like right now where a 10-year treasury note gives you 0.6 or 0.7%, 1.68% is not bad for a dividend. Now, I'd say the biggest threat to this company was the political risk, the risk of a president like Bernie Sanders coming in and completely changing the healthcare system and getting rid of private healthcare. And we did see weakness in the stock through 2019 as a result of this, where more presidential candidates that were in favor of getting rid of private healthcare were doing good in the polls. So there was some fear over that, but I think now we've seen this fear go away. The only 2 candidates left are Joe Biden and of course Donald Trump. And so neither of them, if elected president, would probably do much to change healthcare, at least not to the extreme extent that someone like Bernie Sanders would. So that is good news for this stock. They're at around $298 right now. Back in March, they had a drop briefly under 200, which would have been a great place to pick this up. So now let's look at some other information. All right, so right now we're on Fast Graphs. And so what you can see is the normal PE ratio for a company like this is usually around 17, 18. And that is where the stock has traded pretty consistently. So if you expect the stock to keep trading at that valuation, but to continue seeing the growing earnings, here's what we could see. So if you bought the stock now at the end of 2023, based on a PE ratio of around 19, which is the normal multiple for this company, you could see a price of $467, and that would be an annual return of above 14% for the next 3 years. So there's definitely an opportunity for high returns with this stock. Again, this is expecting that the stock trades at a PE of around 19 and that the earnings do go up as expected. So those are 2 things to keep in mind. If you want to be a little more conservative and say a 17 times earnings, that would still be an 11.5% return. So these are still very good returns you can get with a stock like this that's incredibly high quality. United Health is not going away anytime soon, and they're only going to get bigger. So I think if you're interested in the stock, right now would be a great place to build a position while keeping in mind that it could easily go down in the short term. Something else quick to note on this stock: during the 2008 recession, this company did pretty poorly. During this period of time, they were trading at around 9 times earnings, and as you can see, that kind of valuation stayed at least until around 2013, 2014, when it returned to a PE of around 17. And that probably happened because the growth of the company was slowing down. And so the PE ratio that stock trades at is based on its future expectations. So right now we're at its normal PE, but the expectations are that this stock continues to grow at that 12, 13% rate. that we saw in the estimates. But if we see a huge slowdown in the economy and the growth of this company starts to flat out, we could easily see it return to a valuation like 9 times earnings. And right now that would cut the stock price in half. So instead of being just around 300, this stock could go all the way down to 150 if we see the economy fall off a cliff and the growth of this company really slow down. So that's always something to keep in mind, something like the worst case scenario. Always be prepared for something like that to happen. And the good thing is, this is a great quality company that will always bounce back. So if that ever did happen, and I own the stock, all I would do is just take advantage and average down because it's going to go up in the long run. All right, so the second stock is Nike. Their ticker is NKE, and everyone knows Nike, the famous athletic brand. Probably the best thing about this company is their brand. You just see the Nike logo and everyone instantly knows what it is. And that alone ensures that this company is going to be around for the next 100 years at least, probably even more. So going into the company, the thing I like best about Nike is that they've really kept down their debt levels. Their debt to equity is only a 0.38. And that's something I really like to see in an environment like this where companies are actually taking on debt just to buy back stock. Like I've said in previous videos, Nike has kept their debt levels pretty conservative. Another thing is their growth is actually expected to increase compared to in the past. In the past 5 year, earnings have grown at 10% a year, but in the next 5 years, they're expected to grow at over 23%. So something's happening with Nike that will allow them to continue to grow at a faster pace than they have in the past 5 years. Another thing I really like about this company is their return on assets, return on equity, and return on investments, all in the high double digits. What does that tell you? This tells you that the management team of Nike knows how to effectively use the company's assets, their equity, and how to invest their capital to generate high returns. And that gives me confidence that Nike will continue to take their profits and reinvest it into the business to keep growing their profits, and that will keep them growing for years to come. They have a dividend of 1%. Again, not the best, but it is a dividend that is higher than the 10-year treasury note, so that is always a plus. Now, the bad thing about Nike is that they do look overvalued. Since 2001, their normal PE ratio is around a 22, and right now their PE ratio is over a 30, so it is pretty high. But that being said, if we do see that higher growth with Nike, this is a company you could hold and the growth would catch up to the valuation. And so it could always go down in the short term, but assuming you're buying to hold long term, here are the types of returns you could expect. Being conservative at around 23 times earnings, if you held this stock for 4 years until 2024, you would see an average return of around 3%. And that's the biggest danger of holding a company like this that is overvalued. The returns probably won't be that great at first, but the thing is, if you keep holding it past that point, at the same price, it's going to be pretty undervalued to fairly valued. And if you buy now and hold until that point and past that point, after that, you're probably going to see higher returns. So Nike, for me, not a buy right now. I'd have to see it get lower before I invested in them. For me, the sweet spot for them is right around $50, $50 to $60 in that range. That's a pretty big drop from right now. It's around 50% drop. But if it ever did get there, I'd load the boat on Nike stock. The last stock that I'm going to talk about in this video is Intel. Their ticker is INTC. And Intel is a chip maker. They are a semiconductor company, and this industry has really taken off over the past 10 to 20 years, where companies like Apple and their smartphones and laptops and all sorts of devices need these semiconductor chips. Companies like Intel will benefit because they're the primary chip makers that these companies use. Now, a couple risks to a company like Intel is that those companies could always just go to someone else or start making their own chips, which is what Apple just announced they're going to do. They're probably going to cut their relationship with Intel and start developing chips on their own. So that is probably one of the biggest risks for a company like this. But Intel also has a lot of important agreements with companies like IBM to make all of their chips. And if you take a look at some of the things Intel is doing, they're really putting themselves in a position to benefit from future technology. They have this subsidiary called Mobileye, and they are chips to help with autonomous driving. So things like driver assistance, front vision sensing, driver monitoring, and eventually full autonomy is expected in 2022. So this is a company that will benefit from this shift to autonomous driving, and their chips have a large part in that industry. So out of the three companies, Intel is probably the most undervalued. Their PE is only an 11. Meanwhile, they're expected to grow at around 9%. So that is definitely a fair valuation for a company like this. I would say they're probably a little undervalued even. Another thing I like is their profit margin is 30%. So Intel has kept their costs down and they're able to make a high margin on their semiconductor chips. Like Nike, their returns on assets, equity, and investments are very high. This shows the effectiveness of Intel's management team, that they can take the profits they make and reinvest it back into the business to keep growing their profits over time, to compound the profits that the company makes. And that's really what you want to see happen as a shareholder. Their price to free cash flow is a 20, and that's closer to what I like to see. So this company is definitely undervalued in my opinion, not by a huge amount, but you could definitely expect to see some good returns with this company. So the average PE ratio of this company is a 17.79, but that includes the 2000-2001 tech bubble, so we can take that data out and see what the PE ratio does after we take out that period. And we can see the normal PE ratio shrinks, but it's still around 15, which is higher than it is right now. This company also pays out a 2.2% dividend, which is the highest dividend of the 3 stocks, and it looks pretty safe. Their dividend is safely covered by their earnings. So the estimates for this company go out to only the end of 2022. So if I bought this stock now, I would expect a return of around 13.62% per year, and that is definitely a good return to get for a high quality company like Intel. That total return is factoring in the dividend and capital appreciation. So combined, it would be expected to get an annual return of around 13.6%. Again, this is not definite. It doesn't mean that Intel is going to be that price at the end of 2022. Anything can happen in the short term, and we could see the stock drop even more than it already has. But that's the best thing about long-term investing. You buy a high quality company you're confident in, and then when it drops, instead of being scared, you can just take advantage of those opportunities to buy more of the company because you know it's always going to go up in the long run. So those are the 3 stocks I'm covering in this video. I might start doing this more often, talking about more common stocks that you're going to see a lot more on places like YouTube, and maybe stocks in like the Dow Jones or something like that. So throw out some names in the comments. If you know any of these companies that you want my input on, like it could be, more of these well-known companies like Disney, Google, Amazon, stocks like that, put them in the comments and I'll make a video going over those types of stocks that I haven't talked about yet much on this channel. So if you like this video, hit the like button, subscribe to the channel if you haven't already, and I'll see you on the next video.